Peter Trent from Paragon.
Thank you. Good morning.
Good morning.
Have you noticed things are getting more expensive lately? Yeah. Everything, right? I was just looking, inflation over the last 10 years is up 35%.
Really? Wow.
But you know what's also up? Home values. Home values are up as much or more. And that puts us in a really strange moment right now. Most of you are sitting on more home equity than you've ever had in your entire lives. But at the exact same time, we're feeling this different kind of financial pressure than you might have expected with all this inflation. For some, that pressure is pretty real every single month, just making ends meet. I got my homeowners insurance bill the other day, and it was 30% more this year. Forget the 10-year average.
Mine too.
There we go.
Mine is canceled.
Oh.
Welcome to the club.
Yeah.
And for others, it's, sorry?
Could I just make a very brief comment?
Yes.
So I'm trying to get the state of California to become a fire insurance agency. The plan that's called California Fair Plan has nothing to do with the state of California. The money comes from the private insurance companies, and they only send you the checks, that's it. But if California has millions, billions of buildings, and every building had to have an extra thing onto your property tax, it would be far less than they're also all paying to the private insurance companies now. And we could have better fire departments, more fire departments. Anyway, if you want to join in anything like that and help me out, because I'm working on it myself right now, and I'll tell you all about it afterwards.
I'd love to hear more about that.
Yes.
Personally,
Wow.
my insurance expires on the 30th of this month. I'm working on trying to figure out what I'm doing. But anyway, some people are facing those pressures every month, and some people are doing fine, but they're also just more constrained than they really thought they'd be at this point in their lives. They have enough money to get by, but they're just foregoing that trip to visit family, or they're holding back on helping family. Maybe there's grandkids who need help with college education expenses or things like that. So they're just not living quite as freely as they expected to after working for so many years. So where you fall on that spectrum, maybe you don't need anything, maybe month to month it's an issue, or maybe just holding back on things that you might do. So those three categories are how I see most of my clients falling into this. It's that tension between the wealth on paper and cash flow that's really bringing us here today to talk about reverse mortgages. As you know, I'm Peter Trent. I'm the owner of Paragon Mortgage Group. We've been in Santa Barbara for 35 years now. I've been a broker for 25 years. We do regular conventional financing, FHA, VA, jumbo loans, home equity lines of credit. We do all of them, including reverse mortgages. So we're going to talk a little bit about all those different options at some point. Obviously the focus is reverse mortgages, but we're going to talk about other options that people have that aren't reverse mortgages. So you can figure out whether a reverse mortgage makes sense for you or whether there's another option that works for you. I'm also going to be talking a lot about tax considerations. I'm not a CPA. I'm going to talk about widely quoted things that affect you tax-wise, but if you have specific tax questions, you should ask a CPA because I can't legally give that kind of advice. That said, we're going to talk about general concepts that you've probably heard before and just sort of bring them to the forefront of your mind of things you might ask if you have questions about those kinds of things. We're just going to quickly look over the overview of what we're going to do. We're going to look at the history of reverse mortgages. They've been around a little longer than you might have thought. The common uses for reverse mortgage. I can't even see my screen. Sorry. I'm going to be behind you for just a second. Who shouldn't get a reverse mortgage? And I feel that's a really important part of this. I don't want to be here telling you have to, should, everybody, it's good for everybody. It's not good for everybody. So we're going to talk about that and help you figure out whether it's good for you or not. At the end of the day, I've lived here my entire life. My grandfather and my father, before we were both in the finance business, we look at trying to have good long-term relationships and give you good advice. At the end of the day, I want to be able to walk through town and know I gave everybody good advice. And some people will be, don't get a reverse mortgage. And some people will be, yeah, get one. It just depends. We're going to look at the alternatives to the reverse mortgage. There are other things you could do. There's the process of getting a reverse mortgage. We'll just briefly go over that. How much can I borrow is, of course, the favorite topic. People want to know how much money could they actually get. And then savvy ways to use a reverse mortgage. There's tax strategies where you can use money from a reverse mortgage, which is tax-free. instead of drawing on other taxable things you have, like drawing on an IRA or a 401k you have has tax consequences, but drawing from a reverse mortgage does not have a tax consequence. So that would be a savvy way to consider using reverse mortgage. And then we're going to look at the case studies, which I've talked to a few of you about. We have these silly case studies based on TV families, which are kind of helpful because we sort of know the characters, I think.
Do we know if they got together or not?
Well, I've made some assumptions.
I'm kind of worried about Mary Ann.
Oh no, Mary Ann and the professor end up together.
Okay.
You're going to see she's almost sitting on his lap in one of these pictures.
All right.
I don't think it's a surprise.
Just saying, I'm
They're two really smart, brainy people. Seems like they should end up together. Anyway, reverse mortgages go back a lot further than you might think. The first one was in 1961, and it was just invented out of necessity, just pretty much like everything else. A banker in Portland, Maine, had a good friend die, and he was trying to figure out how to support his widow. And the widow had a mortgage, and they figured out that she really couldn't afford it, so they figured they could lend her the money to pay off her mortgage and not have a payment. And that's effectively what a reverse mortgage is. You get a loan, it either pays off your debt or creates a credit line for you, and then you have no payments. What happens, of course, is the balance is going up because the interest is added to the balance of the loan. That's effectively what a reverse mortgage is, just in a nutshell. We'll get into some more details later on. The modern reverse mortgage was invented much later in the 80s, and we now have what's called the HECA mortgage, the Home Equity Conversion Mortgage. This is an FHA insured product. It is the modern mortgage. It's now been around for, what is it, 12 and 26, 38 years, almost 40 years, right? And it's been refined over the years, but it's still basically the same product. There's also another product that we could be, I think it's going slow, but we'll get to another product. The common uses for reverse mortgage, of course, are paying off your existing mortgage. If you happen to be a senior and you still have a mortgage, or in the case of that example where the woman's husband had died and she still had a mortgage, getting the reverse mortgage could just pay off your existing mortgage and free up whatever payment it was that you were making. Sometimes that's enough just to make everything work. In other cases, you have enough equity so you could borrow more than what you need to pay off your mortgage, or maybe you don't even have a mortgage at all, which is a fortunate position to be in. So you can pay for maybe home health care if you want to age in place. A lot of people look to be able to do that, whether they just need some light kind of assistance at home or whether they need full-on 24-hour care. Those are big expenses, and a reverse mortgage could potentially do that depending on the value of your home. You can plan for the future with a credit line, and that just creates extra security. I have plenty of people who come to me and they just want to have a credit line so they know that money is there backstopping. It's almost like an insurance policy. Just to know that you have this credit line that might be worth several $100,000, it could be $1 million even. Just so it's there in case you need it, if something happens. Maybe that's something that happens is just to buy into Samarkand or some care facility where you need to come up with a bunch of cash all at once. It could also be for home improvements, to update your home to meet new needs if you have physical disabilities and you need to make improvements to your house. You can also lower your taxable income, which is what I talked about, the savvy use of a reverse mortgage, by not drawing on your taxable investments and instead using your reverse mortgage proceeds. You know that when you draw on your 401k and your IRA, that increases your income. It also can affect your Medicare costs. So there's a lot of things to bounce around between here and look at whether it makes sense for you. It may or may not, depending on what your financial situation is. If you're drawing a ton of income from your retirement plans and paying a lot of taxes, and a lot of people are paying more taxes in retirement than they really ever thought they would be, that could be a reason to switch it. You can certainly provide money for loved ones, for down payment or for education expenses, grandchildren, for example. And then you could also purchase a second home, which is a unique way to look at it. If you had a home with a lot of equity and you wanted to buy a second home closer to where your grandchildren live maybe, or other family, it might be a good idea to get a reverse mortgage, buy that other property, and you have no payment on it, and then you can be spending time there as well. Or maybe you buy a home in a vacation place where the whole family likes to come, whether that's in the mountains, at the beach, at the golf course, whatever it is, to get family to come together.
In a situation like that, Peter, do you still retain ownership of the house on which you took the reverse mortgage?
You always retain ownership of your house on a reverse mortgage, regardless of how
Even if
you
you buy
use the
another
money.
property?
right? So it's just like any mortgage. When you take out a mortgage, you always own your house. You still have the responsibilities to maintain it, pay the property taxes and insurance. It's just that at the end of the loan on a 30-year mortgage, maybe you're still alive and you have a house that's free and clear. At the end of a reverse mortgage, it's either because you've moved out and you're still alive and you sell your house, or because you pass. So it's a different situation, but you still own the house the entire time. If you do pass and there's equity in the house, then your heirs get the equity. And we'll get into that a little bit more. See, that's a common misconception that you don't own your house.
No, but the question was really, if you decide to use the money from the reverse mortgage to buy another house, are you required to keep the first house? Yeah, well, you do.
Oh,
You'd have
yes.
You'd have to pay off.
You'd have to pay it off.
Pay it off, sure.
And you have to live in the main house
Yeah.
for at least 6 months out of the year,
Okay.
because it has to be your primary residence. We'll get into that too. And then having funds available for a long-term care, as I mentioned, if you were on the list for Samarkand or one of those kinds of places where you need to pay hundreds of thousands of dollars to get in, that's the financial security part. Just knowing, hey, I don't have to sell my house this month. I've got 6 months when I can sell my house. Let's pay that entrance fee to Samarkand, smoothly move in, fix up the house as it needs to be. You know, Nancy and Rachel can give you advice on staging and cleaning and decluttering and so forth, so you're getting the most for your house instead of a panic sale where you're just in a pinch to make it happen. So that's where the financial security of having a credit line could maybe be a huge thing for you. Who should not get a reverse mortgage? And I mentioned that I think this is one of the most important parts, or at least where I try to counsel people that they should be careful. And the classic person who shouldn't get one is the overspender, the one who's been overspending for a long time. And I see, you know, financial statements all the time. You know, some people have a lot of money and they're overspending still. They've got several leased cars and lots of expenses and high credit card bills and so forth. And that doesn't go away in retirement. Some people just continue to spend. So we are really careful about handing somebody a huge credit line who has exhibited the tendency to spend too much. The concern is, the reason we're getting the reverse mortgage really is to maximize the equity they could take out of their property to live reasonably. But it's not to, you know, go buy a Porsche or, you know, do something crazy. I mean, you could, but it's not. I don't want to see clients doing that. That's not really what it's for. It's really just a backstop. It's to create extra income for you if you need it to keep your home. It's also to take advantage of tax things that could help you. But if it's really to live an outlandish lifestyle that you really can't afford and that you're going to run out of money at some point, I'm going to be sending you to a financial advisor. And we do see that. Someone's not realistic about their long-term income versus expenses. That's kind of the same thing. The overspender who just doesn't really have a good view of what the reality is. And if it's unlikely, if you can't keep up with the things that you really have to pay, property taxes, insurance, maintenance, whether you have a reverse mortgage or a regular mortgage, you have to pay those things. The lender can foreclose if you don't take care of those items. But the home's going to need major improvements, and that's another one. You know, most of you might have had your houses for 10, 20, 30, 40 years, and you love your home, but you might be a little bit unrealistic about what the long-term repair costs are. You might need a roof, you might need a sewer line, you might need new heating. There's all kinds of expenses that can come up, even just regular repair things. If you need a plumber to fix your toilet or whatever, it costs more than you used to. So you just need to be realistic about what stage is your house in its life, and is it realistic to stay there for another 10 or 20 years, or whatever your life expectancy is, and that you will have enough money, both from the reverse mortgage and your other assets, to reasonably take care of it. If you've got several $100,000 of repairs to do, you might say, you know what, this is somebody else's job. It's time to move on. Call Nancy and Rachel and find another option.
Can you talk a little bit more, Peter, about how you would decide if a house has too much need of repair? I'm just thinking of different people I know that are in the situation. Well, that's the very situation they're in. They're house rich, but don't have extra cash, but their house does probably need a lot of work. How do you change?
So there's a lot of things that go into that.
Yeah.
Obviously, if they have a huge capital gain, if they were to sell, that might influence that they have more aptitude or ability or need to fix up the house they're in. Obviously, whether they really need that house or really want that house all goes into it. But certainly there are people who you meet who may just seem that, taking on a large project, if it's that significant, there's foundation issues and roofing and so forth, that maybe that's just beyond their comfort level. That could be a fairly small number. For other people, getting a new roof isn't that hard. You get 3 bids and they come and do it in a week and it's over. But, if it's gonna be something that's very disruptive, you've got asbestos or some issue that you're trying to deal with, or mold, then it might be like, yeah, this is a really invasive project. So it's gonna be on a case-by-case basis. I don't think there's a one-size-fits-all.
Right, so like if you see a house and you go, wow, it needs a lot of this, but they still wanna live there, they could potentially get a reverse mortgage.
Yes, as long as it's, the appraiser doesn't call out some major issue, like the roof isn't actively leaking.
Okay, gotcha.
Things like that. So it has to be, it doesn't have to be beautiful, it can be old and dated, it can be dirty.
Yeah.
It just needs to be functional.
Yeah.
So as long as it's functional, then you can probably get a loan on it.
Okay,
Okay? Where are we?
sorry.
That's okay.
That was hugely helpful.
So the concern is, for this person who shouldn't get a reverse mortgage, is that they would be drawing out a lot of equity out of their home because they haven't budgeted for all these things and they're spending wildly, and they run through all the money and then suddenly they're in a pickle. We really don't want you to get there. We want you to have a reasonable expectation of what your income sources are, what your expenses are, and to budget the money. If we all knew how long we were going to live, it would be a heck of a lot easier.
That's just the whole thing.
That's the hard part. We have to, penny pinch forever, and then, you just don't know what it's going to be. So then, if we,
Are you
yes,
going to take questions later, because I don't want to interrupt you while you're.
I'm going to take lots of questions, yes.
Okay.
But if there's something really relevant right now, we can talk about it.
Well, the one question would be like, if you have a lot of equity in your home, and the time has come, maybe my example, I had a 5-year loan, and now it's going to convert over to whatever it's going to be in September, because it was very low interest, it was below 3% for an outside. So, would you know?
Those days are
gone
gone.
forever. And so the question is it better in a case like that? I mean, a reverse mortgage is a little bit simply, it's a reverse mortgage, exactly. So is it better to just remain when you're going to have to refi or do something else and just take a bunch of money out then to a mortgage?
It depends. I mean, if you take a bunch of money out with a mortgage, you're going to have a higher payment for that. And so for some people, you have to qualify for it too.
Yeah.
So if you qualify and you can afford the payment, fine. That's going to be a lower interest rate generally than on a reverse mortgage, generally. But making that payment is usually what steers somebody more towards a reverse mortgage or considering the other options that we're going to discuss now.
Especially if you're not paying income tax on what you take out in a reverse mortgage.
Right.
That's a big,
Yes.
right?
So if you're one of those people who shouldn't get a reverse mortgage because you're that chronic overspender or for whatever other reason, you should definitely have to consider the other options, which of course are selling the home. That would be the number one thing, right? But you have a possible capital gains tax. That capital gains tax is if your profit is more than $500,000, if you're a married couple and you've lived in the home for at least the last 2 years, or more than $250,000 if you're a single person and you've lived there for more than 2 years. Then you're going to pay capital gains tax on the excess profits above that. And so you're going to see in some of our case studies, especially when one partner is a lot older or has a health condition, there might be a strategy to say, well, let's wait, we want to age in place anyway, and when one or the other passes, you're going to end up with a stepped up basis, which means that capital gain tax goes away completely, depending on how you hold title, but for almost everybody in this room, it's probably going to completely go away. At which point, that would be an opportune time to sell because you could get all of the money from the house instead of 30% less from paying capital gains taxes. So otherwise, you could rent out the home. Rents are super high in Santa Barbara right now. You don't get to live there anymore, but that could solve your financial problem, right? If we're just talking about the finances, that's something to certainly consider. Rents are really, really high. The typical home in Santa Barbara is going to be well over $5,000 a month. 5 to 10 is kind of a pretty general range for homes in Santa Barbara, and there's some that are a whole lot more than that. That could make a big difference to somebody's monthly income. You have to live somewhere else, of course. So is the rent enough to make it worth it? You could refinance your existing mortgage for a lower payment. And you might think, well, how could that work? Rates are higher now than what I had. Well, depending on how old your mortgage is, sometimes even at a higher rate, spreading your mortgage over 30 years again, maybe results in a much lower payment. And that might solve your problem. You get a good fixed rate, maybe not as low as you used to have, but you're probably not going to outlive the mortgage if you get a 30-year mortgage at this point. I'm not going to outlive 30, I'm 62, I'm not going to probably make it. So a 30-year mortgage I'm never going to pay off anyway. So maybe spreading it back out over 30 years and getting a lower payment, maybe that solves the problem. That's a cheap option. But you have to qualify, of course. You can get a second mortgage or a home equity line of credit. That's one of the low-cost options to get too. You only pay interest on what you draw, but of course you have to qualify. So that's another issue. You could get help from family. If you have family members who can help you, some people are fine with doing that. In other cases, that wouldn't work at all, but that's something to certainly consider. If you do go down the route of getting a reverse mortgage, as I mentioned, the HECM, the Home Equity Conversion Mortgage, which is the FHA insured mortgage, is the most common product. Most people get a HECM mortgage. It's like I said, it's insured by the FHA, and the major limitation with the HECM is that they'll only consider your home value up to $1,249,000. So if you have a $2 million house, they're going to base the loan amount on the idea that it's only worth $1,249,000. That works for a lot of people, but for some people it doesn't. So there's other products that will consider the whole value of your home, but the HECM is the one we're focusing on right now. So no matter what your home value is, if it's more than $1,249,000, they're going to use $1,249,000. If it's less than $1,249,000, which most homes in Santa Barbara, there's not too many of those anymore, but if it were, then they would use the lower number. You have to be 62 for a reverse mortgage with the HECM. It has the lowest rates, which is one of the best things about the HECM. It's good if you have a fairly small mortgage. Again, because we're only using that $1,249,000 number, we can't pay off a mortgage of $600,000, $700,000, $800,000 unless you're quite old. We're going to see it kind of caps out at around $700,000, and they're at age 90, we get about $700,000 with this product. So if you're 80 or 70 or 60, the numbers go down because your life expectancy is longer. This is all based on life insurance tables, where they're looking at your expected lifetime to determine what the balance is going to be on that lifetime.
Is that pretty much across the board for almost every type of reverse mortgage?
Yes, that's the concept. So the concept is, lenders are really good at figuring this out. They don't want to lose money, right? So they're looking at a group of borrowers, not any one person, but life insurance tables say that if you're 70, your life expectancy is about 15 years. If you're 80, your life expectancy is like 7 or 8 years. And if you're 90, your life expectancy, is still, if you make it to those milestones, you still have a longer life expectancy. And so they're looking at what they expect the average interest rate to be, how much the balance is going to grow over time, how much the property value is going to change over time, so that they can ensure that there's a pretty good chance they're going to get paid off. And we'll talk about what happens if they don't. Nothing is the short answer. They eat the difference. But
Really? Not
yes.
a bankruptcy kind of
No. So anyway, we'll get to that in just a second. But yes, that's how this works. They're looking at your age, your expected lifetime, and they do a calculation based on that. The older you are, the higher the percentage of the value of your home you can borrow. So you can see for this 90-year-old person, they're getting $700,000 based on $1,250,000. That's a little over 50% of the value of their home.
What if the value of your home is higher? Does it always depend on 50% of the home value?
Yes, it's about 50% is a good number just to hold in your mind. So if you had a $2 million house, maybe $1 million. We'll explore some of those numbers in depth as we get a little further. All right. There we go. So the modern reverse mortgage is a proprietary product. We're not talking about the FHA product anymore. They will consider the full value of your home. And this is good if you need a larger loan amount. They don't have that limitation of $1,249,000. In our example, if you had a $2 million house, they base the loan amount based on $2 million. These proprietary products that are not the FHA product also include second mortgages, which also could be a really good way to do it if you had a nice 30-year fixed rate at a very low rate, you had a very high value home, then maybe you could get a second mortgage with no payments that would take care of your financial needs. Was there something else here? Oh, and if you're thinking about full-time in-home care, that's a pretty expensive proposition. There's probably people here who could confirm this, but I think you're looking $25,000, $30,000 a month at best for 24-hour care. So if you're trying to budget for that, going for this kind of loan might be the right thing, especially if you have a fairly high value loan, because then you're looking at unlocking a lot of the equity that potentially could provide for that. The differences between a traditional and reverse mortgage, there's really only a couple of differences that are really important. Of course, they both have a loan amount and they both have an interest rate. But the term is one of the things that's different. So on a typical mortgage, you're looking typically at a 30 or 15-year amortization. But on a reverse mortgage, it's for as long as you live in the house. So how long is that going to be? It could be 10 years, it could be 20, 30, 40 years, depending on the age you get the reverse mortgage at. So we'll get into that further as to exactly how that works. But the loan ends when you're not living in the house as your primary residence anymore. There's a monthly payment, of course, on a regular mortgage, and there's no monthly payment on a reverse mortgage. Again, one of the hallmark differences between the two. The mortgage balance goes down every month on a regular mortgage, but it goes up on a there we go. The balance goes up every month on a reverse mortgage, simply because you're not making the payment. They're saying, okay, you borrowed $500,000, there's an interest rate, and every month that you're not making a payment, we just add it to the balance. That's why we want a reverse mortgage, so we don't have to pay every month. You can receive your money just as a lump sum with a traditional mortgage, but with a reverse mortgage, you can choose a number of different ways. You can get a lump sum, you could get a monthly payment, or you could just get a credit line that you draw on when you need it. So, for example, for that Samarkand example, maybe you don't need any money. It's just someday you need $300,000 to buy in there. You write a check and you're done. So you can use the money however you want in that sense, or receive the money however you want. You can default on a reverse mortgage just like you can default on a regular mortgage. There's different ways that it happens, but it's worth looking at what's exactly the same and what is different. Obviously, if you don't make payments on a traditional mortgage, they're going to foreclose. We obviously know that, and on a reverse mortgage, it's not applicable. They can't foreclose for that. But the things that are the same is you've got to pay your property taxes. If you don't pay them, they're going to foreclose. You got to pay your insurance, and you got to pay your maintenance. So those are all exactly the same. You got to pay on all of those. If you don't pay those items, they're going to foreclose, whether you have a regular mortgage or a reverse mortgage. One of the differences, if you're not living in the home as your primary residence. On a traditional mortgage, they don't care. You could be living in it when you get the mortgage. You could move out later and rent it out. You could leave it vacant. You could do whatever you want. There's no difference. But on a reverse mortgage, as I mentioned, you have to pay off the loan if you move out. If you're not going to be living there as your primary residence, the loan becomes due. So most people are looking at a reverse mortgage at staying for the rest of their lives. But if they don't do that, then they do pay it off at that point. Then paying off a reverse mortgage, as I have alluded to, there's basically a few things that could trigger that. One is if you're not living in it as your primary residence. So if you live somewhere else for more than 6 months out of the year, even if it's just staying with family for more than 6 months, suddenly your home is not the primary residence anymore. You need to be in your home 6 months and 1 day every year for it to be your primary residence. But they do allow a 12-month absence if you happen to be in extended convalescent care. So if you have a surgery or something and you're out for a long period of time, that's not considered leaving the home as long as you're back within 12 months. Once you get to that 12-month mark, then by then it's probably pretty clear that you're not going to be able to come back home, at which point the loan becomes due. And of course, it also becomes due on death. I can't see my screen.
You have to write a check in that case?
Well, you're not going to be writing a check. I need to get here so I can see the screen just a little bit better. So once of those events occur, you have 6 months to either pay off the loan or refinance, or you can sell it. For the HECM loan, you can have 2-3 month extensions. You can have up to a year to figure out what you're going to do. If you happen to be alive, then you're going to be handling that. Otherwise, it's going to be your heirs. They can either pay off the loan because they want to keep the house by refinancing it, or they could sell it if they don't want to keep it. Does my clicker work from over here? What if the mortgage balance is more than the home is worth? That's always a concern. And the thing with the reverse mortgage is it's non-recourse financing, and that's a legal term that basically means the lender has no recourse to the borrower or to the heirs if the balance is more than the home is worth. They accept that if for some reason the math has worked out, that the property's gone down in value and the loan balance has gone up, that they will accept whatever funds are generated from the sale of that home as the full payoff. So you're not responsible for it, your heirs are not responsible for it. It was, in that sense, it was free money. Of course, they're very good at doing these math calculations.
Very often.
There you go. They've been doing this for a long time. It's not a good business proposition to lend money they're not going to get back, and so over long periods of time, they found that their math generally works, and so that you would have remaining equity, and so that your heirs would benefit from that equity, or like I said, they could buy the house if they want to. So one of the things about a reverse mortgage is the heirs, if you did owe more than it was worth, the heirs can buy the house for 95% of the appraised value. So if you had a home that had $1.2 million in debt on it, and it was worth $1 million, you could buy it for $950,000. That $200,000 of extra debt goes away, and they give you a little bit of a discount because they know they're going to have costs of selling it, and it's easier just to have you buy it at a discount than to have to go through the marketing expense. My clicker doesn't work very well. There it is. The process of getting a reverse mortgage is pretty straightforward. Of course, you have to be 62 for the FHA mortgage, and 55 for the various other programs that we talked about, the proprietary mortgages. You
That's
have
the
to,
minimum age.
yes.
Yeah.
As long as you're 55 or older, you can get the proprietary loan, and you have to be 62 or older for the HECM. You have to have decent credit. Doesn't have to be spectacular, but decent. Either if you have no loan or a fairly small loan relative to the value of your property, it's probably going to work. Ultimately, that's my job to figure out if it's going to work. But somewhere around 50% of the value of the property is kind of the limit. At that point, you'll complete an application, and then you'll complete a little counseling session on the phone with an FHA counselor who goes through the loan product that you're getting, the pluses and minuses of it to make sure that you understand it. I feel like that's my job, that hopefully when you go to that counseling, you know all the answers, you've been well studied. But it is a required step just to be sure that you have a really clear understanding of what's happening. Then at that point, we get the appraisal, and then the loan documents, and the loan closes. So it's a pretty straightforward process once you decide to do it and figure out which product you want. And I think
Oh, I had a quick question.
Yeah.
I'm trying to think, who is actually lending? Is this traditional banks or what companies are involved in this? Because
I'm a broker.
you're the broker, so
Right.
who's actually lending the money?
So there's a couple of different lenders that do reverse mortgages. The HECM product is by a bunch of different lenders, insured by the FHA, and the proprietary products are proprietary to any lender that offers it. There's really only a couple of lenders doing the proprietary products. And so it's an investment from their side, if you look at it, it's just an investment. They're saying, if we lend Barbara $500,000 and we're happy to earn this interest rate for whatever her lifetime is, and we're willing to take the chance that maybe her home won't be worth as much as the loan balance in the future, they're looking at it as an investment. They're willing to make that return and take that chance. It's just like a life insurance policy. When they sell you life insurance, they're saying, well, your life expectancy is 85 or you're 70. They do the math on that to be sure that they can afford, on average, to pay out that life insurance claim even if you die at 72, right?
So these are not traditional banks. This
These
is
are-
not Montecito Bank and
No.
Trust or
No.
Community Bank or
No,
whatever.
these are
Okay.
larger investment companies that make these kinds of loans. The how much money I can borrow, I think, is probably the #1 question. And as you look at the HECM, you can see with our $1,249,000 value, which was the maximum value we can use for the HECM, at age 55, you can't get anything because you have to be 62, right? But at 62, it starts out at about $400,000, and it works its way up to $727,000 for a 90-year-old person.
And is that the max?
Those are the maximum numbers for the HECM. And it
Or
mainly,
does that depend on the value of the house?
well, I'm saying if your home is worth $1,249,000 or more, these are the maximum numbers.
Okay.
Because HECM limits the value of your home to $1,249,000. Even if you have a $2 million, $3 million, $4 million house, they're gonna base it on $1,249,000. And in Santa Barbara, you guys could tell me, but probably 95% of the houses are worth more than $1,249,000. If you get into condos and so forth, they could be less, but that's kind of what we typically see here. So it gives you a sense of what the numbers are. If you go with the proprietary mortgage, the numbers go up quite a lot because now we get to count the whole $2 million property value. And as you can see, even at 55, you can get over $600,000, and it caps out at about $1.1 million for a 97-year-old person. Again, now these numbers would vary quite a lot depending on the value of your property. If the property was $1.3 million or $4 or $5, it's going to be a lot different than these numbers. If it's $2.5 or $3 million, it's going to be a lot more than these numbers. But just to give you an idea, just to look at a $2 million house is getting you roughly half the value of the house at age 90, just in round numbers. So for that $2 million house, if the client had a $1 million mortgage, they could at least pay it off, right? And if they had no mortgage, they'd have a credit line of $1 million. If they had a couple $100,000 loan, they'd just pay off that couple $100,000 loan and still have an $800,000 credit line. So those are, we have to look at your specific situation to see how much we're paying off and whether that actually works. Come on, quicker. There we go. So how you receive your money, I've touched on this a little bit. You can get it as a lump sum, of course. You can get it as a credit line. You get it as a combination of things. You can get a monthly payment, just like your Social Security check, if you want to just have some number show up in your checking account every month. I think most people probably use it just as a credit line and draw on it as they need it. But some people know they need $1,000 every month. So they get their Social Security coming in, they have whatever retirement benefits they have, and then another $1,000 from the plan, or whatever number works. But there's a number of different ways to draw it. How to use the money? Like I said, number one thing is just pay off your mortgage, right? Plan for the future, financial security, provide funds for kids for college. You can really use the money any way you want. If it's to buy a Porsche, we'll have to have a conversation. You're allowed to do that, of course.
But we take you for a ride.
Oh, well.
What about a Maserati?
A Maserati? Fancy people in this room. Again, you can use it for anything you want. I do have an eye towards just financial responsibility. So I joke about it. And it could be financially responsible for some people to do something that seems outlandish to somebody else. It depends on your financial situation. So, seems like very slow. So a reverse mortgage is part of a savvy retirement plan. As I mentioned, really the number one thing would be able to not draw as much on your taxable investments. That might be a really good way to use it. Another thing is, for some people, they're downsizing. So they're going to sell a big house, get a bunch of money, and they want to pay cash for the new house. Well, you might talk to your financial advisor about that. They may say that it's a better hedge against inflation to take some of that cash and invest in things that are going to keep up with inflation, and maybe get a reverse mortgage to buy that new house. So you put maybe 50% down, or depending on your age, 50, 60% down, get a small reverse mortgage, and that frees up some cash that can go into investments and keep up with inflation. Inflation is the number one evil, I think, in retirement years. Obviously, if all of your income is indexed to inflation, that works, but there's some things that just aren't following inflation. Homeowners insurance, like I've said, gasoline at the moment, but that probably won't last. So you can consider different ways to use the money that might be a good hedge against other taxes and things that you might not have thought of originally. So we're going to go to the case studies at this point. And really the purpose of the case studies are really just to help analyze specific situations and what might be a good solution for these particular borrowers. As I've put on your table, they're all TV families. If you were a TV family in the 60s and 70s, hopefully you have some sense of these characters. I think it makes it a little more fun, and it makes it so we can relate to these people just a little bit. So our first one is Gilligan's Island. Fortunately, this is not a 3-hour tour, it's about 30, 40 minutes. You all, I think, have these cheat sheets
Yes.
to take a look at. We're just gonna go over them just very quickly here. But as you see, Marianne is almost sitting on the professor's lap, so I decided that they must have ended up together. They're two very intelligent people. It just seemed like they might have some synergy. I know it's a little silly. But anyway, they got together, but sadly the professor has died. So she's alone. She's 79 in good health. Her mother lived to 100 years old, so she has good genes. Her home's worth $1.2 million. Her living expenses are $1,500 a month. But she loves to travel. We're on item 5 right now. She loves to travel and go on cruises and tours. Well, that's not surprising. That's how she ended up on that dang island in the first place, right? And she's spending $2,000 a month on those activities, and she has a $400,000 mortgage at $1,900 a month. So she's spending $5,400 a month, and her pension is $3,000 a month. So she's got a $2,400 negative every month. She's afforded the lifestyle by drawing down her savings account, which has $120,000 in it, but it had $300,000 5 years ago.
That's not gonna last very long.
Pardon?
It's not gonna last very long.
Exactly. She can't account for where all the money went either. I mean, that $300,000 was earning interest and so forth. I mean, she's really kind of gone through it more than you would expect. She qualifies for a $500,000 reverse mortgage. It'll pay off her mortgage and leave her with a $100,000 credit line. She's excited for the reverse mortgage, so she'll have the $1,900 mortgage payment that she doesn't have to make anymore. But should she do it?
But is she gonna live in a tree? Eventually.
My takeaway of this, and you probably have a sense where I'm going, she can't account for where her money's going. She's spending $5,400 and she has $3,000 coming in. It's pretty myopic, not recognizing, what's happening. And so, while this might work for her, it's only going to work if she really gets serious about it. So I'd be sending her to a financial advisor to really get serious about, what could work. It might be, though, because the professor died and she got a stepped-up basis, that this is the time to not be so sentimental about that house. Sell it, get into something that makes more sense, pocket a whole bunch more cash, and get it to a financial advisor so she doesn't spend it on too many trips. So it'll last her lifetime. So this is the kind of client I'm worried about. I mean, I love Marianne and the professor. They were a great couple. They would have been a lot of fun. But I think she's just out of control in her spending. That's my view, and she needs to get realistic. And my hunch is selling the house and she doesn't have that capital gain is probably the solution. Her next one is All in the Family. My grandparents loved this show. I think I was terrorized as a kid. But Edith and Archie Bunker, if you remember them. So the daughter and son-in-law Gloria and Michael, they've moved to upstate New York where they run an organic farm with their 4 children. Kind of makes sense. They were kind of hippie-ish, right? Yeah. Edith has been nagging Archie to move closer to the grandchildren for years. Well, that's totally on character. She was always nagging him. Michael and Gloria were relatively early investors in Apple stock and have done well. Archie invested at Michael's urging a bit, and so while he's not rich, he has a substantial position. He doesn't want to sell their home in Queens because of the capital gains taxes. But Edith continues to nag, and even Archie's getting worn down. She wants to move up there to be close to the grandkids. A modest condominium near Michael and Gloria is $450,000. What should they do? So I find myself in the strangely enviable position of envying the Bunkers. Like, who could have ever thought that? They could do anything.
Yes.
They could literally do anything. So they could get a reverse mortgage and go buy that place. They could sell their house because they're rich enough to afford the taxes and move on. They could sell some of that Apple stock and just go buy that place up north. They could do any of those things. So this is one of those ones where you just kind of shrug and go, boy, they really lucked out. Michael and Gloria Meathead really came through with that, getting them to invest in that Apple stock. So anyway, they're in a very fortunate situation. I think they have a lot of different choices. A reverse mortgage could be one of them, and they could do a number of different things. The last one is the Brady Bunch. You remember Alice, the housekeeper? She ran a very tight ship, and she, on at least a couple of episodes, I had to Google this stuff. On a couple of episodes, she had a romantic interest in the butcher, Sam the butcher. If you see his picture, you might recognize him. But they've been married for 25 years. They have a beautiful home in Los Angeles. They have no mortgage. And Alice has, of course, run a tight ship, but they've suffered financially because they've made some unfortunate investments over time. It just didn't really work out, and they haven't really recovered from it. Inflation has eaten into their nest egg. Sam has some health issues that have been battling for 5 years, and he isn't expected to live more than another 3. They're comfortable financially, and the income's enough to support them. However, they both want to remain in the home, and they worry about whether their investment income, Social Security income, and will be enough, especially if they need to make improvements to the home to accommodate Sam's declining health. What should they do? Well, this is that classic situation where they have a big capital gain tax if they sell. Sam's not going to be around forever, and they both really want to stay in the home. A reverse mortgage really could work for them. And of all people that I would trust, it would be Alice. She runs a tight ship. She's not going to go buy a Porsche. I make fun of Porsches, but anyway, she's gonna take good care of that money, and I think it's gonna do really well for them. So the purpose of this really was just to give you these sort of extreme examples and remind you of some of the hallmarks of what might put somebody in one category or another. Really, the way to do this in a much better way is to come in and have a consultation. Sorry, I didn't change the screens here. I'm busy talking. Would be to come in and have a consultation, and you do have a sheet on your table there where you could request some additional information, a checklist to go through, how to use your home to stay in your home, which is a publication, and of course you could ask for a scheduled meeting to get together and discuss your specific situation. I don't really expect you to apply all these concepts to your specific situation, but the idea was to try to give you some familiarity with it so you can think about it and have a way of talking about it as you talk to friends or family or me. So if you want to fill that out, I'm happy to send you the information and see how that might help you or how that leads to the next thing. Question?
I have a question for you. Are you able to take a reverse mortgage and still maintain the original mortgage? Or do you have to pay it off?
You can get a second reverse mortgage. So just like a second. So you have your first mortgage,
First mortgage.
and then you can get a second position mortgage that's a reverse mortgage if you have enough equity in your home.
Okay.
But most reverse mortgages are a first mortgage and you pay off your existing.
But you don't have to pay off the first one.
You don't have to if we get you a second mortgage. There's a specific product that's for a second
Is
mortgage.
that what you would call a line of credit then?
And
Later on, that you don't need it?
in the case of that particular product, the second mortgage is a one and done. So if you get a $500,000 second mortgage, you get a $500,000. You don't get a credit line with that second. There is a new product that is just coming out that I believe will work as a credit line based on that, where you don't make payments and the same kind of thing. We're going to have that product in the next few weeks, but that's a new one.
But you said earlier that you could use a reverse mortgage as a line of credit.
And generally, that's true. The only exception to that is if you get it as a second mortgage. The second mortgage is a one and done. You get your second mortgage amount, $500,000, let's say, and you're going to get a check for $500,000. It's not a credit line. But as I said, we're going to have a product in the next month from a different lender that is a reverse mortgage. That's a second that can be used as a credit line.
Excuse me, Peter, on your list here, you have this thing called reverse mortgage. This is a booklet or a
Yeah, it's a
document?
pamphlet.
A pamphlet, so if I check that, you'll give me the pamphlet.
I'll either mail it to you or email it to you if you provide an email address. I think that pretty much covers everything. If you have any questions, I'm happy to take them now, or if you want to ask personally, I'm happy to do so too.
Peter, I think a while ago, Rachel and I sent you to someone, and it'd just be good for people to know. She wanted a reverse mortgage. We met with her, and her house did not meet the expectations, if I remember correctly. And can you talk, was that the FHA one, or the other one? Does the other one still have to meet the expectations?
Your house has to be in decent condition. I don't recall exactly who this is. There was somebody I met that I think you referred me to where it just wasn't going to work for her.
Right, yeah. Or the
And
house.
the house was a bit of a hoarder house too, but we looked at, she had people who could help her clean it out so that she could get the mortgage.
Mhm.
There wasn't otherwise anything really inherently wrong with the house, but it just wasn't gonna work for her with what she needed to do. I believe she had an existing mortgage that we weren't gonna be able to pay off completely. And so she'd have to come out of pocket. So that happens sometimes. We have somebody who has, let's say, a $400,000 mortgage, but we can only get them a $300,000 reverse mortgage. So they can use the $300,000 to help pay off the $400,000 mortgage, but they have to pay it off completely. So they have to take $100,000 out of pocket to be able to do that. They're $100,000 less in their savings, but they're not making a mortgage payment on that old $300,000 mortgage. So that could work for some people, even if the loan amount's not quite enough. And that's why sitting down and really going over your situation could really highlight all the different options. And at the end of the day, maybe you decide to do nothing. Maybe you decide to sell the house. Maybe you decide to get a reverse mortgage or a second or a home equity line of credit. Kind of conversing in all those things. And of course, we have Nancy and Rachel to help if you decide to move on. Maybe you then get a reverse mortgage on the new house or no mortgage, pay cash. So we can talk about all those different options. Yeah.
What expenses are there in applying for a reverse mortgage?
So on a on the FHA HECM loan, there is a significant expense for the HECM because the FHA charges an upfront mortgage insurance fee. And that gets taken out of the loan proceeds. So all the numbers I've shown you are net of all expenses, but the FHA mortgage insurance fee that they charge is significant. It's about $25,000.
A year?
No, once.
Oh.
Okay, so you have about $25,000 plus $5,000 in standard closing costs, so the title, escrow, appraisal,
Yeah.
those kinds of things. But there's an extra $25,000 because the FHA charges that. If you go with the proprietary product, the closing costs are much less because they don't have that upfront charge from the FHA. You're looking at about $6,000 to $8,000 in closing costs. But again, all of those numbers I gave you were net of all expenses to try to give you a realistic idea of how much actual cash would be generated after the closing.
So, following up on these very good questions, what are the advantages and disadvantages of going either with the FHA loan or the proprietary loan? Is it because the FHA isn't regulating this field, or, I mean, what's the reason?
The advantages of the FHA loan is the interest rate is lower, which really in theory doesn't matter because if you're never going to pay it off, it doesn't really matter. But if at some point you are going to pay it off, having had a lower interest rate helps.
And
Interest
also,
rates-
it would be interesting if you want to leave your house to your kids and they decide to sell it after you die, then
the
they don't
balance
have
is
to
going to
pay
be
as
lower.
much, of course.
Right, the balance would be lower.
Yeah, of course.
There are some other features that make the FHA loan a little more attractive, in my opinion. Any part of the credit line that you have not used actually grows every year. So it grows by the amount of the interest rate. So if the interest rate was 6 1/4 and you had a $100,000 credit line you hadn't used, at the end of the year it grows to 106, 250. And so there's a sort of carrot and a stick thing which is good for the overspender one, to try to preserve some of your credit line because it's growing all the time. On the proprietary product it grows, but not as generously, and it's only for the first 7 years. The thing that I've seen though, I've had a client that got a HECM because he thought that would be sufficient, and then realized later that he was really going to need more. And that's a really inefficient way to do it. I tried to convince him to get the larger one initially, but instead we did it twice. So he paid that $25,000 FHA fee and then refinanced into the larger one. He's glad he got the larger one now, but the loan amount is usually what drives the decision. If you can clearly deal with a smaller loan amount of an FHA loan, that's the better deal, in my opinion. Even though you have to pay that high upfront mortgage insurance fee, the lower interest rate, the fact the credit line grows for the entire life of the loan, and the credit line is live for the entire life of the loan. In other words, you can draw on it for the entire term. Whereas the proprietary product, we're getting into details here that might be too much, but the proprietary product, you can only draw on the credit line for 10 years. So if you get to the end of 10 years and you still have credit line left, you need to draw it all at that point if you still want to use it. So there's a lot of different nuances here. And so really it usually comes down, the simplest way to think about it is, well, how much money do I really need? Am I trying to stay in the home and have home health care and so forth? Probably we're gonna be looking at the proprietary product, because if we can get you $1 million, that's what I got that client. Got him $1 million, and now, you know, he's really clear on he can stay in his home as long as he wants. On the other hand, if he'd gone with the FHA product, it would have been a lot less than that. And so, you know, once you define what your goals are, it'll probably steer you to one or the other. But if it's equivocal and you're kind of in between choosing, I would tend to go for the proprietary product just to free up as much equity as you can, in case you want to use it. At the end of the day, for most people, this is just sort of a financial backstop, and having a bigger financial backstop might be a much better situation for you.
How does the VA figure in?
I might have said VA one time, it's just FHA,
Oh, okay.
What does VA stand for?
Veterans Administration.
Okay.
But the Federal Housing Agency is the FHA.
What about maintenance? I mean, what has to be done to make the house the way they want it for a loan? In other words, how much maintenance do you have to have? Like if there's a problem with the roof, but the roof doesn't need a complete replacement, well, is that a problem or?
As long as the roof isn't leaking. When the appraiser comes out, if they see, you know, stains that suggest current leaking, then they're gonna call that out, and that would be an issue that would need to be either resolved or shown that maybe it has been resolved and the stains just haven't
But
been
how
painted
can you
over.
get it resolved if you don't have the money to do it? You know?
There are situations where they can do a set aside out of the credit line to take care of repairs and so forth.
Oh, yeah.
So that is a possibility where they set aside the money to do something like that. The more common thing is they'll set aside money for taxes and insurance. If they're looking at your budget and thinking you're gonna be tight on taxes and insurance, they say, all right, well, we're giving you a $500,000 credit line, but we're gonna set aside $100,000, I'm making the numbers up, that you cannot access, and we're gonna pay the taxes and insurance for you over your lifetime. So that is another way they handle that.
Okay.